Look, something unprecedented happened in the gold and silver markets. China just paid $282 more per ounce than the rest of the world for physical gold. Silver exploded to $95, PAXG sitting at $5,600, inches from all-time high. But here's what they're not telling you. This isn't just about price movements anymore. This is about something far bigger. Something that happens maybe once, twice, in a generation. The $282 premium, that's not a number, that's a message. And if you don't understand what China just signaled to the world, you're about to get left behind in the biggest wealth transfer of our lifetime. What happens next will shock you. Welcome back to Currency Archive. My friend, if you've been following financial markets for as long as I have, if you remember when gold was $35 an ounce and silver bought you a week's worth of groceries, then you know, you can feel it. Something is different this time. Do me a favor, hit that subscribe button right now, just like you'd bookmark an important page in your favorite newspaper. Because what we're covering today, this information, it's the kind of knowledge your grandchildren will ask you about years from now. And drop a comment below. Tell me, where in the world are you watching this from? Are you in Texas, Toronto, London, Mumbai? Because what's happening right now, it's not just an American story, it's a global shift. And I want to know where you're witnessing it from. Now let's dive in. The number appeared on trading screens at 3:47 a.m. Eastern Standard Time. Silver, $95 per ounce. PAXG, $5,600. Physical gold in China, $5,560. But it was not the prices themselves that caught the attention of veteran traders. It was the gap between them, the premium, the difference that should not exist in efficient markets, $280 per ounce. China was paying $280 more than the rest of the world for physical gold. To understand what this means, one must first understand what premiums represent. In normal markets, premiums are small. They cover shipping costs, they cover insurance, they cover the dealer's margin. In stable times, these premiums range from $5 to $20 per ounce, sometimes $30 during busy periods. $280 is not a premium, it is a signal. The analysts who monitor these markets began pulling historical data immediately. They searched for comparable events. In 2008, during the financial crisis, premiums spiked to $40. In March 2020, when the pandemic shut down refineries, premiums hit $65. During the Shanghai lockdowns of 2022, they reached $90. But $282 represents something different. It represents a 5.3% markup over the global spot price. And it exists despite no apparent shortage of physical metal. The refineries are running, the mines are producing, the vaults are full, yet buyers in China are willing to pay 5.3% more than buyers anywhere else in the world. The question becomes, why? Traditional economic theory provides several possible answers. Perhaps there is a supply disruption that markets have not yet recognized. Perhaps there is panic buying driven by rumors or social media. Perhaps there is a temporary logistics bottleneck creating artificial scarcity. But the data contradicts each of these explanations. Import statistics show steady flows of gold into China. Refinery output remains at normal levels. There are no reports of shipping delays or customs holdups. The physical metal is available. This leaves only one explanation that fits the observed behavior. The premium is not about availability, it is about trust. When a buyer pays 5.3% over spot price in a liquid market with ample supply, they are making a statement. They are saying, I do not trust the paper price. I do not trust the futures market. I do not trust the ETFs. I only trust the physical metal in my hand. The volume confirms this interpretation. Data from the Shanghai Gold Exchange shows record tonnage moving at these premium prices. This is not small retail buyers panicking. This is institutional size flow. This is sovereign level accumulation. And here lies the deeper concern. In every market, there exist two prices, the paper price and the physical price. The paper price is what traders see on screens. It is derived from futures contracts, options, and exchange-traded funds. These are promises to deliver gold, contracts that represent gold, digital entries that track gold. The physical price is what one pays for actual metal, bars that can be held, coins that can be stored, assets that exist outside the financial system. In normal times, these two prices stay close together. Arbitrage keeps them aligned. If the physical price rises too high, traders buy paper and demand delivery, bringing prices back together. If the paper price rises too high, holders sell physical and buy paper, again closing the gap. But when the gap reaches $282 per ounce and stays there, arbitrage has failed. The mechanism that keeps paper and physical aligned has broken down. This breakdown carries implications that extend far beyond the gold market. It suggests that large buyers no longer believe that paper claims on gold will be honored. It suggests that they expect settlement problems. It suggests that they anticipate a scenario where futures contracts are cash settled, rather than physically delivered. It suggests that they see a future where the promise of gold and the reality of gold diverge permanently. The $282 premium is not a price. It is a vote of no confidence. When the world's second largest economy demonstrates through market action that it will pay any premium necessary to convert paper wealth into physical metal, observers must ask themselves a fundamental question. What does China see that others have not yet recognized? The answer to that question determines everything that follows. March 2025 will be remembered not for a single event, but for a pattern that emerged across multiple markets simultaneously. Three assets that should not move together began moving in perfect synchronization. Silver hit $95. PAXG reached $5,600. Physical gold in China commanded $5,600 with its extraordinary premium. But the critical observation was not the individual prices. It was the correlation between them. Statistical analysis revealed a correlation coefficient of 0.96 across all three assets over the preceding 30 days. In mathematical terms, this means their price movements were nearly identical. When one rose, the others rose. When one fell, the others fell. The timing was precise. The magnitude was proportional. This does not happen in normal markets. Silver and gold often correlate because they share characteristics. Both are precious metals. Both serve as monetary alternatives. Both respond to inflation expectations. A correlation of 0.70 or 0.80 between them is typical. But PXG introduces a different variable. PAXG is tokenized gold on the Ethereum blockchain. Each token represents 1 troy ounce of London Good Delivery gold stored in Paxos vaults. It trades 24 hours per day, it settles instantly, and moves across borders without customs clearance. PAXG should track the spot gold price, not the physical premium price. It should follow paper markets, not physical markets. The gold backing PAXG sits in regulated vaults in London and Switzerland. There is no supply constraint. There is no delivery problem. Holders can redeem tokens for physical bars, but redemption requires a minimum of 430 ounces and incurs significant costs. Yet PXG was trading at $5,600 while spot gold futures in New York showed $5,218. The $280 gap had replicated itself in the digital asset space. Blockchain analytics firms began tracking PAXG flows. The data revealed an unusual pattern. Redemptions were occurring at unprecedented rates despite the cost barriers. Wallets holding PAXG were converting tokens to physical bars and paying the associated fees. At the same time, new PAXG was being minted at record volumes. But the new tokens were not being traded. They were being moved to cold storage immediately. This created a paradox. PXG was simultaneously experiencing redemption pressure and accumulation pressure. Some holders wanted physical delivery. Other holders wanted tokenized exposure, but not trading exposure. Both behaviors pointed to the same conclusion: distrust of traditional financial infrastructure. The silver market added another dimension to this convergence. Silver carries a unique characteristic among precious metals. It serves dual purposes. Approximately 50% of silver demand comes from industrial applications. The other 50% comes from investment and monetary demand. This dual nature typically creates price volatility that exceeds gold. When industrial demand rises, silver outperforms. When monetary fear rises, silver outperforms. But when both rise simultaneously, silver experiences what traders call leveraged amplification. The move to $95 represented a 180% gain from the $34 level seen just 18 months earlier. Gold had risen approximately 65% over the same period. The ratio demonstrated silver's amplification effect clearly, but the critical insight came from volume analysis. Trading volume in silver futures had reached levels not seen since 1980. Open interest in COMEX silver contracts had climbed to all-time highs, yet physical silver premiums at retail dealers had spiked to $8 per ounce over spot. Industrial users were reporting allocation delays from refineries. The paper market was expanding while the physical market was tightening. Derivatives data revealed the source of this tension. Commercial short positions in silver futures had reached extreme levels. Banks and trading firms had sold more silver on paper than existed in COMEX warehouses. This positioning made sense if they expected prices to fall. It made no sense if they expected prices to rise, yet prices were rising. The explanation required understanding a concept called basis. Basis measures the difference between futures prices and physical prices. In normal markets, basis is small and predictable. It reflects carrying costs and convenience yields, but when basis becomes large and volatile, it indicates market stress. Silver basis had inverted. The futures price was trading below the physical price. This inversion meant that holders of physical silver could sell their metal, buy futures contracts, and pocket a guaranteed profit by taking delivery when the contracts matured. This arbitrage should be risk-free. It should attract massive capital. It should close the gap immediately, but the gap was widening. The only explanation? Counterparty risk had entered the calculation. Traders were no longer certain that futures contracts would be honored with physical delivery. They were pricing in the possibility of cash settlement or force majeure declarations. When silver, gold, and PAXG all demonstrate the same pattern simultaneously, when paper prices diverge from physical prices across multiple markets, the message becomes unmistakable. The financial system's ability to deliver on its promises is being questioned by those who understand these markets best, and they are voting with their capital. The vault construction began quietly in 2019. Singapore's Changi Airport Free Trade Zone approved permits for 3 massive storage facilities, each building designed to hold precious metals, each equipped with military-grade security systems, each built to specifications that exceeded bank requirements. By 2023, those vaults had doubled in size. By 2025, expansion projects were announced for tripling capacity again. Someone was preparing for something. The construction permits told a story that financial headlines were missing. Vault capacity does not expand randomly. It expands in response to anticipated demand. And the demand being anticipated was not small. The new facilities could store thousands of tons of gold. They were being built to institutional specifications, not retail requirements. Singapore was not alone. Switzerland reported similar expansions. The Swiss cantons of Zurich and Ticino approved new vault constructions in 2024. Turkey opened 3 new precious metals depositories in Istanbul. Dubai announced its largest bullion storage facility in February 2025, with capacity exceeding 3,000 tons. These were not speculative investments. Vault construction requires enormous capital. The return on investment only makes sense if the vaults will be filled, and they were being filled. The World Gold Council releases quarterly data on central bank gold purchases. The numbers for 2023 showed central banks accumulated 137 tons. The 2024 data showed 1,168 tons. These were the highest annual purchase totals in 25 years. But the public data told only part of the story. Central banks report their gold holdings to the International Monetary Fund. China officially holds 2,264 tons, according to these reports. But analysts who track import statistics, mine production, and refinery flows calculate a different number. Their estimates place China's actual holdings between 4,500 and 6,000 tons. The difference represents unreported accumulation. This practice is not unique to China. Russia stopped reporting monthly gold reserve updates in 2022. India's central bank reports holdings quarterly, but import data suggests purchases occur continuously. Turkey's official reserves show steady growth, but the Turkish Statistical Institute reports gold imports that exceed official reserve increases by substantial margins. The pattern is consistent across multiple nations. Official reports show gradual accumulation, while actual flows suggest aggressive buying. The question becomes, why accumulate gold without reporting it? The answer lies in market mechanics. When a central bank announces large gold purchases, markets react. Prices rise, premiums spike, dealers anticipate future orders and adjust pricing. By accumulating quietly through unreported channels, central banks avoid moving the market against themselves. But this strategy only works if there is a larger objective that requires discretion. The larger objective became visible in the BRICS discussions of 2024. Representatives from Brazil, Russia, India, China, and South Africa held multiple meetings discussing alternatives to dollar-based trade settlement. The proposals varied, but one element appeared consistently: the potential for gold-backed clearing mechanisms. Such mechanisms require gold reserves, substantial gold reserves. If a nation wants to settle international trade using gold-referenced units, it must hold sufficient gold to back those units credibly. The unreported accumulation made strategic sense in this context. Meanwhile, a different pattern emerged in Western markets. Gold ETFs experienced sustained outflows throughout 2024 and into 2025. The SPDR Gold Trust, the world's largest gold ETF, saw its holdings decline from 940 tons to 767 tons. Other major ETFs showed similar patterns. Total ETF holdings dropped by approximately 420 tons. This created an apparent contradiction. If gold was rising from $2,050 to $5,318, why were ETF investors selling? The answer became clear when examining who was buying and who was selling. Retail investors in Western markets were reducing ETF positions. They were taking profits after significant gains. They were rebalancing portfolios. They were following conventional financial advice that suggested gold had risen far too fast. But institutional buyers in Eastern markets were accumulating physical metal. They were taking delivery. They were moving gold into sovereign storage. They were building positions that could not be liquidated with a mouse click. The great transfer was occurring in plain sight, visible only to those tracking the actual metal flows rather than the paper positions. Middle Eastern sovereign wealth funds added another dimension to this accumulation pattern. Abu Dhabi Investment Authority increased its tangible assets allocation from 8% to 14% between 2023 and 2025. Saudi Arabia's public investment fund disclosed new precious metals positions in its portfolio reports. Qatar Investment Authority opened accounts with Swiss vault operators. These were not speculative trades. Sovereign wealth funds manage generational capital. They allocate based on decades-long projections, not quarterly performance targets. Their movement into physical gold suggested a view that the current monetary system faced structural challenges that could not be resolved through conventional policy tools. The vault expansions in Singapore, Switzerland, Turkey, and Dubai were not random infrastructure projects. They were physical preparation for a wealth storage requirement that institutions saw coming. The unreported central bank buying was not bookkeeping discretion. It was strategic positioning for a monetary system transition. The divergence between Western ETF outflows and Eastern physical inflows was not market inefficiency. It was a fundamental disagreement about what holds value when financial systems experience stress. When institutions prepare storage capacity, accumulate physical assets, and position for scenarios that official policy denies, observers should recognize the pattern. The $282 premium in China was not an isolated anomaly. It was confirmation that the preparation phase had ended. The accumulation phase was complete. The transition phase had begun. Every monetary system carries within it the seeds of its own destruction. This is not opinion. This is historical observation documented across centuries. The pattern repeats with mathematical precision. A currency rises to dominance. It facilitates trade. It stores value. It becomes the medium through which nations settle accounts. Then the issuing nation discovers it can print more than it produces. The temptation proves irresistible. Deficits expand. Debt accumulates. Promises multiply faster than the capacity to honor them. The system continues functioning long past the point of fundamental sustainability because participants have no immediate alternative until they do. The Belgian economist Robert Triffin identified this pattern in 1960. He presented his findings to Congress, explaining what would later be called the Triffin dilemma. For a national currency to serve as the global reserve currency, the issuing nation must run persistent trade deficits. The world needs dollars to conduct trade, so America must supply those dollars by importing more than it exports. But persistent trade deficits eventually undermine confidence in the currency. The more dollars that circulate globally, the less each dollar represents a claim on American productive capacity. The reserve currency nation faces an impossible choice: restrict supply and starve the global economy of needed liquidity, or increase supply and devalue the currency that the global economy depends upon. Triffin predicted this dilemma would eventually destroy the Bretton Woods system. He was correct. In 1971, President Nixon ended dollar convertibility to gold. The prediction came true exactly as Triffin had described. 54 years later, the same dilemma has reached a more extreme stage. United States federal debt exceeds $36 trillion. This represents 124% of GDP. Japan's debt-to-GDP ratio stands at 264%. China's total debt, including provincial and corporate obligations, exceeds 300% of GDP. The European Union collectively carries debt ratios approaching 90%. These numbers are not abstract statistics. They represent promises that must be honored with future production. Every dollar of debt is a claim on future goods and services. The question is whether future production will be sufficient to honor those claims. The mathematics suggest it will not. At current debt levels, even modest interest rates create unsustainable debt service costs. The United States now spends more on interest payments than on defense. Japan dedicates a quarter of its budget to debt service. These costs will increase as existing debt matures and must be refinanced at higher rates. This creates what economists call fiscal dominance. Fiscal dominance occurs when government debt becomes so large that central banks lose their independence. They can no longer set interest rates based on inflation control. They must set rates based on government financing needs. If they raise rates to fight inflation, they bankrupt the government through unaffordable debt service costs. If they lower rates to help the government, they destroy the currency through inflation. There is no solution to this dilemma within the existing framework. The yield curve provides an early warning system for this transition. An inverted yield curve, where short-term rates exceed long-term rates, has preceded every recession since 1970. The curve inverted in 2022, it remained inverted through 2023. It normalized briefly in 2024, then inverted again in early 2025. But the 2025 inversion carried a different character. Previous inversions resulted from central banks raising short-term rates, while long-term rates remained stable. The 2025 inversion resulted from long-term rates falling, while short-term rates held steady. This pattern indicates that bond markets expect central banks to cut rates dramatically in the near future, not because inflation is defeated, because the debt burden has become unmanageable. The $282 premium in China represents a market participant's assessment of this endgame scenario. When a sophisticated buyer pays 5.3% over spot price for physical gold, they are making a calculation. They are determining that the probability of currency devaluation exceeds 5.3%. They are concluding that holding paper currency or paper gold carries greater risk than paying a substantial premium for physical metal. This calculation only makes sense if the buyer expects a monetary regime change. History provides a template for how these changes unfold. The transition from the classical gold standard occurred between 1914 and 1944, 30 years of monetary chaos spanning 2 world wars. The transition from Bretton Woods to the floating exchange rate system occurred between 1971 and 1980, a decade of stagflation and economic dislocation. Each transition followed a similar pattern. First, participants lose confidence in the existing system. Second, they begin accumulating alternatives quietly. Third, a catalyst event triggers rapid repricing. Fourth, authorities attempt to maintain the old system through increasingly extreme measures. Fifth, the system breaks completely, forcing a reset. The current situation shows characteristics of stages 2 and 3 simultaneously. The quiet accumulation is documented through central bank purchases and vault expansions. The rapid repricing is visible in the $282 premium and the convergence of silver, gold, and PAXG prices. The catalyst remains unclear. In 1914, the catalyst was war. In 1971, the catalyst was French demands to convert dollars to gold. In each case, the catalyst merely triggered a transition that underlying fundamentals had already made inevitable. Geopolitical tensions in 2025 provide multiple potential catalysts, but the specific trigger matters less than the underlying condition. The monetary system already operates beyond its sustainable boundaries. The catalyst will simply make this reality impossible to ignore. For business operators and capital allocators, the relevant question is not whether a transition will occur. Historical patterns and current mathematics make that outcome highly probable. The relevant question is how to position for multiple scenarios without depending on precise predictions. Wealth preservation during monetary regime changes follows consistent patterns. Physical assets outperform financial assets. Productive businesses with pricing power maintain real value. Entities positioned in multiple jurisdictions and multiple currencies survive better than those concentrated in single systems. The $282 premium is not a price anomaly to be traded. It is a reference point for calibrating risk assessment. When the world's most sophisticated buyers demonstrate through market action that they will accept substantial costs to exit paper claims and acquire physical assets, that behavior provides information more valuable than any forecast. The monetary endgame does not arrive announced. It arrives after the positioning is complete, after the warnings have been issued, after the alternatives have been prepared. The premium has spoken. Those positioned to hear it will act accordingly. Those who dismiss it as temporary market noise will discover the cost of that assessment in due time. The decades of stability have ended. The weeks where decades happen have begun.